guess what nobody tells you about the stock market? The average investor makes about 3.7% returns per year. Warren Buffett, he averaged nearly 20% per year for 60 years. That difference turned $10,000 into over $200 million. Same market, same time period, completely different results. The difference isn't luck, it's not insider information, it's strategy. Today, I'm breaking down exactly how the wealthy really invest and why you might have been doing it wrong. This isn't theory. This is the blueprint. Let's begin. Most people treat the stock market like a casino. They buy when everyone else is buying, and they panic when everyone is selling. Then they wonder why they're broke. Meanwhile, the wealthy are playing a completely different game. They understand something most people never learn. The stock market isn't about timing the market, it's about time in the market. In the next 10 minutes, you'll discover the real history behind stock market wealth, how compounding creates millionaires, and the exact strategies billionaires use. This is your masterclass. Pay attention. Let's start with a truth bomb. The S&P 500 has averaged over 10% annual returns since 1957. That means if you invested $10,000 back then and never touched it, you'd have over $22 million today. But here's the catch. Most people don't last that long. They quit during the crashes. The stock market wasn't always this accessible. Before the 1900s, only the ultra-wealthy could invest. There were no mutual funds, no ETFs, no apps on your phone, just private deals and insider access. Then came the game changers. In 1929, the Great Depression wiped out almost 90% of stock value. Investors learned a hard lesson: fear kills wealth. In the 1940s, mutual funds were born, allowing everyday people to invest. Then, in 1971, the Nasdaq launched as the first electronic stock exchange. The internet boom of the 90s democratized investing even further. The dot-com crash in the 2000s taught another lesson: hype destroys portfolios. Then came 2008, the Great Recession. The S&P 500 fell 37%. But those who held on, they doubled their money by 2013. We saw it again in 2020 when the market crashed 34% in just 33 days, only to rebound to all-time highs within 6 months. The pattern is clear. Every crash is followed by a recovery, and every recovery is followed by growth. The wealthy understand this. That's why they don't panic. They know the stock market isn't a casino. It's a money printer, if you just know how to use it. Let's get into the mechanics of how the stock market actually works. When you buy a stock, what are you really buying? It's simple. You're buying a tiny piece of ownership in a company. So when you buy Apple stock, you own a tiny slice of Apple. If Apple's value goes up, your slice gets more valuable. If Apple makes a profit, you get a piece of that profit. So how do you actually make money? There are two main ways. The first is called capital appreciation. You buy a stock for $100, the price goes up, and you sell it for $150. Boom, you just made $50. The second way is through dividends. This is when a company shares its profits directly with you, the shareholder. Take Coca-Cola, for example. They've paid out dividends to their investors for 62 years straight. Now, there are three main types of investors. First, you have day traders. These are the people buying and selling stocks within hours or days. It's super high risk, and frankly, 90% of them lose money. Then there are growth investors. They buy into companies with huge potential and hold onto them for years. This is where real wealth is built. Finally, there are value investors, like the legendary Warren Buffett. They find great companies that are undervalued by the market, buy them, and wait for everyone else to catch on. But here's the real secret. It's not about picking the one perfect stock. It's about finding good, solid companies and holding them long enough for the magic of compound interest to do its thing. And the math behind this will absolutely change your perspective. This next part is where most people's brains short-circuit. It's called compound interest, and it's the reason Warren Buffett is worth over $150 billion. Here's how it works. Let's say you invest $10,000 and it grows by 10% in the first year. You now have $11,000. The next year, that $11,000 grows by another 10%. Now you have $12,100. See what's happening? You're not just earning interest on your original $10,000, you're earning interest on your interest. Let's look at the numbers. $10,000 invested at a 10% annual return for 10 years becomes almost $26,000. After 20 years, it's over $67,000. After 30 years, it's $174,000. And after 40 years, that same $10,000 with zero additional contributions becomes over $450,000. But it gets even crazier. What if you added just $500 a month to that initial investment? Over 40 years, at that same 10% return, you'd end up with $3.2 million. Warren Buffett became a billionaire at age 56. Almost all of his wealth, 99% of it, came after that. That is the insane power of compounding. Albert Einstein called it the eighth wonder of the world. Buffett calls it a snowball. You need to call it your strategy. Alright, so here's the blueprint. This is how rich people actually invest. Strategy number 1 is index funds, also known as the Buffett way. Warren Buffett's advice for most people is simple. Buy a low-cost S&P 500 index fund and hold it forever. Why? The S&P 500 tracks the 500 largest companies in the US. You're basically buying a piece of the entire economy, which historically returns about 10% per year on average. You don't have to pick stocks or time the market. You just buy and hold. Strategy number 2 is dividend aristocrats. These are passive income machines. We're talking about companies that have increased their dividend payments for at least 25 consecutive years. Think Coca-Cola, Johnson & Johnson, Procter & Gamble. You get paid just for owning their stock. And the key is to reinvest those dividends to supercharge your compounding. Strategy number 3 is value investing, Buffett's core strategy. The idea is to find a company that's worth $1 but is selling for 50 cents. You buy it, hold it, and wait for the market to realize its true value. This takes research into things like management, earnings, and debt, but it's how fortunes are built. All right, strategy number 4, dollar cost averaging. This is how you take emotion out of the game. Instead of trying to guess the market's next move, you simply invest the same amount of money every single month. Is the market high? No problem. You just buy fewer shares. Is the market low? Fantastic. You get to buy more shares for the same price. Over time, this averages out all the ups and downs. Panic is officially removed from the equation. Strategy number 5 is even simpler. Hold 4 decades. There's a saying that the stock market is a device for transferring money from the impatient to the patient. Think about it. Most of Warren Buffett's massive wealth was built after he turned 50. Time asterisk in asterisk the market will always beat asterisk timing asterisk the market every single time. So why do most investors fail? Let's be brutally honest. Reason 1, they panic sell. The market drops 20%. They freak out, sell everything at a loss, and then they completely miss the recovery. The wealthy, they do the opposite. They buy asterisk more asterisk when there's a crash. Reason 2, they chase hype, GameStop, crypto, meme stocks. They hear the buzz, buy at the absolute peak, and then lose it all. Rich investors ignore the hype. They invest in boring, reliable, solid companies. Reason 3, they pay way too much in fees. A 1% management fee doesn't sound like a lot, right? But over 30 years, that tiny fee can cost you hundreds of thousands of dollars. Compare that to a low-cost index fund, which might charge just 0.03%. That difference compounds against you. And the fourth and biggest reason they fail, they just don't start. Time is your single greatest asset in investing. The earlier you begin, the more time compound interest has to work its magic for you. Even just $100 a month, started at age 25, can become over $379,000 by age 65, assuming a 10% return. The best time to start is today, not tomorrow, today. So here's your step-by-step action plan. Step 1, open a brokerage account. Fidelity, Vanguard, Charles Schwab, they all offer zero commission trades. It literally takes 10 minutes. Step 2, start with an index fund. Buy an S&P 500 ETF like VU or SPY. This instantly diversifies your investment across 500 of the biggest companies. Step 3, automate your contributions. Set up automatic transfers. Whether it's $100, $500, or $1,000 a month, whatever you can afford, consistency is key. Step 4, reinvest your dividends. Turn on the Dividend Reinvestment Plan, or DRIP. This automatically uses your dividend payments to buy more shares. Step 5. Hold through the storms. The market will crash. It always does, and it always recovers. Don't panic, don't sell. If you can, buy more. The stock market isn't some secret club just for the rich. It's a tool. It's a proven system for building long-term wealth. The average investor fails because they don't have a strategy. But now you do. You know the strategies billionaires use. The only question left is, will you act on it? In 20 years, you will wish you had started today. So start today, open that account, buy that first share. Your financial future is a choice you make. Choose wisely. If this video changed how you see investing, drop a comment below saying, "I'm starting today," and hit that subscribe button because we're breaking down the real strategies for wealth and financial freedom every single week. Let's get it.